Nio Inc. ADR is currently trading at $4.50 USD on the New York Stock Exchange, marking a drop of 0.20 or 4.36% so far today, February 2, 2026. While the broad market is reacting to a mix of macroeconomic signals, the specific pressure on this company comes from a stark contrast between what the public expected for the start of the year and the reality of the numbers that just hit the tape. Most people looking at this ticker see a nearly 100% year-over-year growth in January deliveries and think the stock should be soaring, but the market is actually punishing it for a 44% month-over-month decline. This is the classic trap where a massive headline number masks a cooling trend that professional traders are picking up on before the average retail investor. While the company celebrated crossing the 1 million cumulative delivery milestone this week, the smart money is looking at the 27,182 vehicles delivered in January and wondering if the momentum can actually be sustained without further aggressive price cuts that eat into already thin margins. You might hear a lot of talk about how the Chinese electric vehicle market is the only place to be for high growth potential, and for a while that was the dominant narrative. The common belief is that as long as the volume keeps growing, the valuation will eventually take care of itself. But if we look at the actual data, the reality is far more complicated. We are seeing a synchronized pullback across the entire sector, with even the biggest players showing signs of fatigue. When you compare the performance of Nio to something like Tesla stock, you realize that the global appetite for pure-play electric vehicles is hitting a wall of consumer exhaustion and shifting policy. Investors who are used to the steady climb of Nvidia stock or the stability of Apple stock are finding the volatility here almost impossible to stomach. The intraday movement we are seeing right now is a direct reaction to the fear that the aggressive incentives launched in early February, like the 0.49% financing offers, won't be enough to lure buyers back after the holiday rush. It is a tough environment for individual brokerage accounts to navigate because the technical levels are breaking down just as the fundamental story gets more crowded. If you are using a platform like Robinhood or Interactive Brokers, you've likely seen the alerts hitting your phone all morning. The volume is high, but it is skewed heavily toward the sell side, suggesting that institutional players are trimming their positions to wait for a clearer entry point later in the year. If we look at the institutional activity from the last quarter, there's a clear divide. Some large funds are adding to their positions, betting on the long-term infrastructure, while others are exiting because they don't see a path to consistent profit before 2028. This tension is why the stock feels so heavy. It isn't just about how many cars they can build, it's about how much it costs to sell each one. Unlike the automated strategies you might find with Schwab Intelligent portfolios, which might keep you in a broad basket of assets, self-investing in a single name like this requires you to understand the granular details of the Chinese subsidy landscape. The recent return of purchase taxes in certain regions has acted like a cold shower for the industry. When you look at the trading data on the Fidelity mobile app or through the Interactive Brokers platform, the bid-ask spreads are widening and the volatility is spiking. This usually happens when there is a lack of conviction. People want to believe in the premium branding and the battery swapping network, but they are terrified of the cash burn. For someone looking at online investing options, the choice between a diversified set of Fidelity ETFs and a high-stakes bet on a single car company is becoming much easier to make. The risk-reward profile has shifted, and not necessarily in the favor of the bulls. To understand why this 4.36% drop matters, we have to look at what the company actually does beyond just making cars. They have positioned themselves as a lifestyle brand, almost like a technology company that happens to sell vehicles. Their battery swapping stations are a massive differentiator, allowing users to swap a spent battery for a full one in minutes. This effectively decouples the cost of the car from the battery, which is the most expensive part. They call call this battery as a service. It sounds great on paper and helps lower the entry price by about 25%, but the capital expenditure required to build and maintain these stations is astronomical. This is why the path to being a profitable company remains so elusive. Historically, the performance has been a series of spikes followed by long, painful grinds lower. We saw a brief period where it seemed like they were finally pulling away from the pack, especially with the launch of Envo and Firefly brands aimed at the family and high-end compact markets. However, the reality of the Chinese economy and the intense competition from BYD and Xpeng has forced everyone into a race to the bottom on pricing. If you are managing your own Fidelity IRAs or a Robinhood stock trading account, you have to ask yourself if you're buying a car company or an infrastructure project. The business model relies heavily on the idea of a user enterprise. They have these Nio houses, which are basically high-end social clubs for owners. It builds incredible brand loyalty, but it also adds to the overhead. While companies like Tesla have moved toward a more lean, software-focused model, Nio is doubling down on physical touchpoints. This is a massive bet that the premium consumer will stay loyal even when cheaper, more efficient alternatives are available. Right now, the market is signaling that it prefers the lean approach. Looking ahead, there are a few catalysts that could change the direction of the stock. The launch of the ES9 is scheduled for April, and there is a lot of hope that this model will capture a higher margin segment of the market. There is also the continued rollout of the Nio World Model 2.0 software, which is their answer to the autonomous driving push we see from everyone these days. They are using 4 NVIDIA Orin X chips in their high-end models to power this, showing just how much they are relying on top-tier hardware to stay competitive. If the software can actually deliver a human-like driving experience as they claim, it could justify the premium price tag. But there are significant risks. The global trade environment is becoming increasingly hostile toward Chinese exports. Even if they can dominate their home market, the path to expansion in Europe and North America is blocked by tariffs and political tension. This limits their total addressable market and puts more pressure on the domestic Chinese consumer to carry the weight of the company's growth targets. For those using SoFi Active Investing or other investing sites to build a portfolio, these geopolitical factors are often more important than the quarterly delivery numbers. As we move through 2026, the question of liquidity will come back to the forefront. They ended last year with a decent cash cushion, but at the current rate of spending on R&D and station expansion, that cushion won't last forever. We might see another round of equity financing, which would mean more dilution for current shareholders. This is something that often catches people off guard when they are focused only on the product and not the balance sheet. I want to hear from you on this. Comment below how many shares of Nio Inc. you currently hold and what your average cost basis is. Do you think the battery swapping model is the winning strategy, or is it just too expensive to maintain in the long run? I'm curious to see how many of you are still holding through this volatility, or if you've moved your capital into more stable areas like Fidelity mutual funds or larger tech caps. To wrap this up, the current situation for the stock is the perfect example of the tension between a company's long-term vision and the short-term demands of the market. The vision is a fully integrated premium ecosystem with seamless energy replenishment and advanced AI driving. The reality is a company that is still losing hundreds of millions of dollars every quarter while facing a brutal price war in its own territory. The 44% month-over-month delivery drop is a seasonal reality, but it's also a warning sign that the hyper-growth phase might be maturing into a much more difficult fight for market share. If you are looking for investment help or exploring online investment platforms like SoFi Invest or Fidelity Wealth Management, the takeaway here is to look past the top-line growth numbers. A 96% year-over-year increase looks impressive on a slide deck, but when the stock is down 4% on the day the news breaks, you know the market was looking for something more. The expectation was that the new brands would have a more immediate impact on the totals, but the reality is that the rollout is taking time and costing a lot of capital. The path forward will depend on whether they can hit their break-even targets without sacrificing their brand identity. It's a narrow path to walk. For now, the stock remains a high beta play that is highly sensitive to every bit of data coming out of the Chinese consumer sector. Whether you are using the Robinhood app for quick trades or interactive brokers for a more professional setup, keep a close eye on the margin data in the next earnings report. That will be the true test of whether the strategy is working. The current price of $4.50 USD reflects a market that is skeptical but hasn't completely given up. There is a floor established by the massive infrastructure and the 1 million loyal users, but the ceiling is being held down by the weight of the competition and the cost of their ambition. It's a classic story of a company trying to build the future while the present is still trying to figure out how to pay for it. As we see more updates on the ES9 and the global trade situation, we'll get a better sense of whether this current dip is a buying opportunity or the beginning of a longer trend lower. For now, stay grounded in the data and don't let the hype of the headlines distract you from the reality of the balance sheet. Managing an individual brokerage account requires a level of discipline